Today I'm going to show you how to basically make any trading system or algorithm profitable using a simple money management technique that only requires a 20 to 30% win rate. That is a really low win rate, and so that's why you're able to implement it into basically even some of the worst trading systems out there. And I'm going to do it all today for free. This kind of information is what big traders charge you thousands of dollars for, and I'm just going to be doing it all for free because I think that you're owed that as a trader. So much garbage is out there, and that's what my channel is all about, is trying to take all those misconceptions out and tell you actually how trading works. So this today is a huge asset, and I hope that you can find benefit in using it in your systems as well. So let's get started. As many of you know, I specialize in building and optimizing trading algorithms. So algorithms that trade the Forex market on complete autopilot. My personally built algorithm is the Ranger EA version 3, and it's up 45.18% since it started back in January 2020. So that is 9 straight profitable months on this account. On the first account that I started was back in 2019, and it's also profited every single month. That's almost 12 straight months of profit. And on the live account, we're now up 13.86%, 1% this week, and really low drawdown of 4.47%. This account started back in July 2020. All right, so I'm going to start a quick slideshow to help you better understand how to implement this money management technique into your trading strategy or algorithm. The chances of it making your system profitable are pretty good, especially since you only need about a 20 to 30% win rate when it comes to utilizing this. All right, so one of the biggest problems with traders right now, retail traders, is they just don't have a good money management strategy or technique or structure. Most think that a stop loss and a take profit is good enough, but that is only scratching the surface when it comes to trading in this market. So what about losses and losing streaks? That's something that's not the sexy topic to talk about when it comes to trading, because most traders online and on YouTube want to just show you their wins, and because that is the hot stuff. But losses and losing streaks happen, and most people don't know what to do with them when they take place, because it's emotional. Emotions happen when losses take place. Well, when we actually have wins, we are excited and we want to make that next trade to make it a winner as well. But when a loss happens, that's when things get tricky. And when a losing streak happens, that's when things get pretty dire, and you don't know how to handle that and what kind of techniques to use to get yourself out of that losing streak, because it seems like when losses happen, they continue to keep happening after that. So what about a risk-reward ratio, and what is best? Now, most traders, and it's been said for so many years, that 3 to 1 is where you should be. You should have your profits be 3 times larger than your stop loss, so your profits can basically recover any of the losing trades or losing streaks that you've had with that risk-reward ratio. Easier said than done, because it's a known fact that it's easier to profit 1 pip in the Forex market than it is to profit 2 pips in the Forex market. That is a known fact, and a lot of people don't realize that's the case, and how to mathematically allow that to give them an edge. So when your losses are smaller than your take profits, that means that the market is going to hit those losses more often, causing losing streaks to happen. So instead of trying for huge wins, why not start at a just simple 1-to-1 risk-reward ratio here? And I've actually had success using a 1-to-13 win-loss ratio, which is pretty incredible, and it actually can really work depending on the system that you're using. Think outside the box, guys. It doesn't always have to be that you have to trade the trend. You don't have to be a trend trader in order to make Forex trading work or any trading system work. You don't have to have a 3-to-1 win ratio. All of these things that people are telling you are very old, rehashed information that gives them the profitable edge, because they're giving you misleading information that's either not working anymore or that's just not working in general. So I want you guys to think outside the box, think differently, because if you're thinking differently, that means that you're thinking differently than the majority of people that are losing. All right. So the next slide I want to show you is the big nuts and bolts of this money management technique. Now, this isn't anything new. This isn't brand new, cutting edge information. This information has been around for a while, but a lot of people don't talk about it very often because they don't talk about losses and how to handle those losses when they take place. So the first trade. So this is the first trade. We're going to be starting at 0.01 lots for this example with a 50 pips stop loss and a 50 pip take profit. The loss potential for this trade is $5, okay? The second trade, if that first trade loses, we lose $5, we're $5 down. And we're going to make this example on a $1,000 trading account with 500 to 1 leverage, okay? So the second trade is 0.02 lots. So that means that we've increased the risk on this given trade by double. So that's 2x on that. And it's the same risk reward at 50 pips take profit and a 50 pips stop loss. Okay, so the loss potential here is $10. So if it's a losing trade, that means we have lost a total of 15 pips or $15. Okay, if it's a winning trade, that means that we have recovered our first initial loss of $5 and we've come out with a profit of $5. All right, so the third trade, $20. If it's a losing trade, then we have lost $35 in total out of 3 trades. But if it's a win, we recover the initial $15 in losses from trade 1 and trade 2. Okay, so the next example here. So this is still dealing with a 1-to-1 risk reward ratio. So the first trade is a level 1, a $5 profit or loss. The level 2, profit or loss 10, 20, 40, 80, 160, and 320. So if we're using a $1,000 account, that means that we have 7 chances in order to 7 chances of getting a profitable trade in order to come out with profit overall from the sequence in its entirety. So if we do lose on that 7th trade, that means that we lose a total of $635, which is a 60% loss on the account. That's pretty heavy. But that's 7 losing trades in a row. And I bet you that with whatever system that you're using, that your chances of having 7 trades in a row is pretty small, especially if you wait 24 hours from the time that you had that first loss. So let's say day 1, you take 1 trade. If it's a loss, don't take another trade that day, wait till the next day, then do level 2 at $10 or 0.02 lots, and then make that progression like that to give yourself a little bit of time to make that recovery trade. Okay, so the next slide. So this is the same thing, but using a risk reward ratio of 1 to 2. So that means a 50 pip stop loss and a 25 pip take profit. So you can still make money management work in this way as well. This just means that you're losing $5 on the first trade, and profiting potential is only 2.5. So that means on the second trade that you need to up the risk to 0.03, and that recovery trade has a potential profit of $7.5. So that means that you recover the initial $5 and come out with a profit of 7.5, which is a total of $2.5. Okay, so $2.50. So the loss potential is 15 on the second trade, and the loss potential for the third trade is 45. So because we're increasing the martingale on the strategy more here, that means that you're going to have less chances to actually come out with a profitable trade. But the nice thing here is that since we have a smaller pip amount, that means that the market has a better chance of hitting our 25 pips than it does of hitting the 50 pips take profit. And that is just how the market works when it comes to mathematics and when it comes to calculating in pips. Okay, so yes, we are increasing the risk higher, but we're also having a smaller take profit, which means that we can potentially hit our take profit on these trades sooner and have a better chance of actually hitting that profit because it's half the amount of the initial stop loss. Okay, so it depends on the system that you're using. If you have a system that needs a smaller pip amount for the take profit, then a 1 to 2 risk reward ratio might work better for you. Okay, so the last slide. So this is tips. This is tips on using this strategy, this money management technique in your current strategy right now. So this doesn't really turn every single system or strategy into a profitable one, but the chances of increasing your profit or giving you a better chance of profiting are much better using this kind of money management technique. And a lot of people when trading, or traders in general, think that the word martingale is a bad word. But this word is actually, in this technique, really can help you become to potentially give you more profit in the long term by using martingale in some way or another. Because we can't always be right on that first trade. We can't always have a 95% win rate and come out and be profitable. We have to account for the losses and the losing streaks that happen, and we have to have a structure in place to combat those losing streaks so we can potentially be a profitable trader in the long term. Okay? So a 20 to 30% win rate is needed, and that's pretty low, but you can see how 7 losses in a row can potentially happen depending on your luck and your system. But seven chances to have a profitable trade is a lot of chances. And if you have a high winning percent with your system, utilizing something like this can be even more powerful. Keep emotional trading out. Okay, so this is having a structure like I was just talking about. If you have a structure like that, utilize a very calculated amount of pip take profit and stop loss with your risk size of each trade, then that will help take some of the emotions out of trading and give you a clear mind for taking better trade opportunities. Okay, adjusting the risk-reward ratio to your liking. So this goes back to, is a 3-to-1 risk ratio better for you? Is a 1-to-1? Is a 1-to-2? Is a 1-to-13 risk-reward ratio? What works for you? And keep in mind that that it's always easier to profit 1 pip rather than 2. Okay? So that's pretty much what I wanted to cover in this slideshow now. So I'm going to show you how this works in forward trading when it comes to utilizing this money management technique. Okay, so the first trade here was a loss at 0.01 lots. All right, so we have the first trade 0.01. The second trade right here, that was a buy trade at 0.2 lots. So we increased the risk by double, so 0.02. And this is using a 25 pip stop loss strategy and a 25 pip take profit strategy. So this is a 1-to-1 risk reward ratio. So the third trade was a win at 0.4 lots. Okay? And then we restart the entire process over again. So trade 1 was a loss, trade 2 was a loss, and trade 3 was a win. Okay? So utilizing that same kind of idea, and you can see that in the strategy, look at that, straight profit up. And we're recovering all the losses, the previous losses that happened. Okay? So what this really does to a trading system is it gives you more opportunity to have losing trades because they happen. And having a structure like this can really turn a losing trading strategy into a winning one. Okay, so I'm going to show you a really powerful trading tool. So this is an indicator called half trend dash 1.02, and I'm going to put this in the description in the video so you can actually utilize this, because I want to give you free trading tools that not a lot of people know about. And this is with my research that I've done. I think I've looked up 5,000 indicators, and this is one of the better ones out there. So instead of trying to get a massive profit from this move, because you're thinking, oh, this is a downtrend, and I could have captured that entire 400 pip move on the pound Swiss franc. That's true, but we didn't know when this trade took place right here that it was going to be a big move like that until after the fact. And so you're thinking, oh man, I wish I would have had that huge trade. But the better way to go about this is taking a small piece of this massive move. So instead of taking 400 pips, why not take 25 of this move? So 25 pips here, 25 pips here, and be done with it. And come out with wins on all of these. Put 25 pips here, 25 pips there, and losing trade, or a winning trade here, and this is also a winning trade, but this one right here, this sell trade, that is a losing trade, and that's why we want to implement a risk management strategy like this, or a money management strategy like this, so we can combat when losses like this happen. So if we have a 25 pip loss on that trade, we were able to recover it on the next trade right after that. So we had a profitable trade right after that. And that's how we should be approaching trading, because we need more chances to, when we have losses, to recover those losses when they happen. It's not about how much profit that you can make in this market. It's about how to protect yourself when losses happen. Okay? So that's pretty much all I want to share with you guys today. I hope you found it beneficial, and I hope to share more tools and ideas like this with you in the future to help your trading and increase your profit with whatever system that you're currently using. Thanks so much for watching. See you next time.